Welcome to the Stock Market Palantir. Today we are going to talk about BQ. We're zeroing in on Baki Holding Limited. Now this is a Chinese ADR, and it's operating in the very challenging pet economy sector. The company has navigated some incredibly volatile, and I mean technically complex events in its capital structure, especially between July and November of 2025. It really presents a fantastic, if painful, case study in microcap distress.
It certainly does.
So the fundamental question we're tackling is whether Baki extreme structural maneuvers, and we're talking massive reverse splits, deeply discounted offerings, or acts of, let's say, painful but necessary capital preservation and compliance, or if they fundamentally represent a classic case of predatory financial engineering that's just designed for shareholder extraction. So for my part, I'll be arguing for the necessity of these. Let's call them survival tactics. Without them, the company simply ceases to exist.
And I'll be taking the other side. I'm going to argue that this is a paradigmatic death spiral. When you see a company utilize this specific aggressive sequence of events, engineering volatility solely to facilitate institutional financing at a steep discount, it confirms that the operational business is a distant second to the business of just selling stock. The evidence, especially when you dig into the market microstructure data around that November offering, it shows us pretty clearly whose capital was protected and whose was, liquidated. And that supports the view that this was fundamentally a mechanism of extraction.
Okay, but let's start with the inescapable operational reality here. Baki is deeply, deeply distressed. We are looking at persistent operational challenges. Sales contraction of over 34% year over year and staggering unprofitability with a return on equity or ROE of negative 47.6%. So given this severe financial distress, the company legally utilized market mechanisms to achieve two critical non-negotiable goals: maintaining their NYSE American listing by getting above that $1 minimum bid requirement, and raising absolutely essential operating cash. The registered direct offering in November of 2025, that secured $4.2 million. That cash bought them time and delayed immediate insolvency. Prudent financial management, I would argue, dictated they seize the window of opportunity created by that temporary market surge.
I agree they needed the cash, but the manner in which they secured it is precisely the issue. You have to look at the historical context here. It reveals a pattern of, just continuous capital destruction. We have to look at the cumulative effect of their structural engineering. I'm talking about the 1-for-8 split in 2022, the 1-for-10 ADS ratio change in January 2025, and then it all culminates in the shocking 1-for-160 split in July 2025.
Shocking, but necessary.
Oh, this sequence is just devastating for long-term holders. Think about it. A shareholder holding, say, 159 shares before that massive split wasn't just left with a low share count. They were forcibly reduced to a fractional share and cashed out. This massive reduction demonstrates that the company's priority has shifted entirely away from realizing its supposed Chewy of China potential, and instead it's focusing on financial maneuvers just to facilitate toxic financing.
I see the point regarding the pain inflicted on existing small shareholders. I do, but let me give you a different perspective on that July 2025 action, the 1-for-160 split, which happened at the same time as the termination of the American Depositary Share, or ADS program. That was triage, plain and simple. If the underlying equity price remains below $1 for too long, the NYSE American issues a delisting warning, and eventually the company is forced off the exchange. That extreme split was a direct, necessary response to avoid that delisting, which would guarantee immediate corporate failure and zero chance of raising capital later. By shifting the structure, they simplified their corporate setup and, crucially, kept their access to U.S. capital markets alive. That's the necessary prerequisite for any future capital raise.
But that triage was entirely focused on manipulating the share count, not on fixing the underlying business. The termination of the ADS program combined with that massive split, it looks less like stability and more like preparation for easier dilution. They artificially inflated the nominal price, creating a new, highly manageable low float, only 2.88 million shares post-split. This low float structure is the classic setup. It is designed to induce extreme volatility on minimal volume, creating the perfect temporary price surge needed to set up a discounted offering. The historical roadmap of repeated splits, it just demonstrates a structural reliance on reverse splits to maintain access to capital, rather than any reliance on operational improvement.
That reliance on volatility brings us directly to the events of October 2025. You characterize the 106% price surge as artificial or manipulated, but I would argue it was macro-driven. This volatility was primarily fueled by speculative capital flowing into high-beta Chinese assets. We saw significant, sharp rebounds in the CSI 300 and the Hang Seng indices during that period, all driven by broader government stimulus measures in China. BARQ being a low-float microcap in a high-risk sector, it just acts as a high-beta vehicle. When the China trade is on, this kind of temporary, explosive move is a natural symptom of sentiment and liquidity, regardless of the underlying fundamentals.
That's a compelling argument regarding macro sentiment, I'll give you that. But we have to consider the company's reaction to that surge, which I believe undermines your whole interpretation of necessity. The no-news press release on Friday, October 31st, right in the middle of trading halts and extreme volume, that was a critical signal. While a financing deal isn't technically material until the definitive agreement is signed, issuing that PR on a Friday afternoon stating they were not aware of any material developments, it effectively cleared the air of rumors. They allowed the speculative retail interest to peak over the weekend and early Monday, driving the price above $5.
They were legally required to issue that compliance statement when the exchange demanded it due to the unusual activity. They simply adhered to regulatory obligations.
But the timing allowed them to utilize the retail-fueled pump to maximum effect before the hammer dropped. The definitive registered direct offering agreement was announced on Monday, November 3rd, pricing the new shares at $2.80. If the purpose was truly survival and minimizing pain, why was the offering priced at an instantaneous 52% discount to the recent high? That discount, it confirms the intent was to maximize the cash raise for the institutional buyer, which resulted in immediate, catastrophic dilution for the retail buyers who had just fueled that pump. The high discount was the compensation paid to the institutional entity for facilitating the whole transaction.
I think you're ignoring the mechanics of distressed financing and the severe operational risk the institutional buyer undertakes here. These structured funds, they demand deep discounts as compensation for funding a company with severe operational challenges and a deep negative ROA of minus 23.7%. The 280 price ensured the deal closed quickly and provided the necessary $4.2 million in capital. They leveraged the high price achieved during the speculative run to get the largest possible cash injection relative to the shares they had to sell to the institutional partner. It was about stability, not about maximum price realization.
Okay, if we want to understand the true financial conviction here, we have to look at where the sophisticated money positioned itself before and during the offering. Let's move past the retail narrative for a second and look into the dark pool metrics. The institutional conviction against this stock is, it's undeniable. We see the cost of borrow BQ shares peaked at an astronomical 307.76% annualized in early November 2025. Just think about that for a moment. Short sellers were paying nearly 1% daily in interest just to hold a short position.
That 300% plus borrow fee is certainly striking, but why does that prove premeditation?
Because no rational financial actor pays that kind of rate unless they have absolute certainty that a major supply event, the massive dilution from the offering, is imminent, guaranteeing the stock price will crash hard and fast. This data proves that sophisticated financial actors knew the dilution event was coming. It allowed them to bet against the very retail buyers who were fueling the pump in October. It confirms the entire volatile period was a premeditated financing setup, not some random market event.
That's an interesting point regarding the arbitrage, but I would frame the institutional involvement differently. We have to analyze the structure of the deal and the involvement of structured funds like Bigger Capital Fund, LP, which held 9.98% of the stock.
Their use of pre-funded warrants and, critically, the 9.99% beneficial ownership limitation demonstrates specialized market making.
Okay, let's clarify that jargon for our audience. What exactly does the 9.99% beneficial ownership limitation mean in practice here?
It's a standard clause in these high-risk financings. It allows these funds to continuously exercise their warrants, which is the right to buy discounted shares, and sell the stock into the market, providing liquidity for the company, all without triggering the regulatory definition of an insider. If they own 10% or more, they would face insider trading restrictions. This limitation allows them to act as high-volume conduits for the company to raise capital quickly, which is necessary because no traditional bank would touch BQ. It is high-risk arbitrage, yes, but it's the necessary structure for distressed financing to actually occur.
But the consequence of that necessary plumbing is clear. It's a mechanism of high-speed value extraction. These funds obtain their shares at $2.80, and because of that 9.99% blocker, they can immediately sell them into the public market, which was trading higher at $4 or $5. They are printing immediate, guaranteed profits by maintaining a high churn rate of exercising and selling, flooding the market with discounted shares, and directly suppressing the price for existing shareholders. The fact that the short side was willing to pay a 307% interest rate proves they knew this massive supply shock from the warrants was guaranteed to hit the market.
The alternative was zero funding. While the process was highly dilutive, yes, and painful, and utilized specialized market mechanics, the outcome was securing $4.2 million. That capital gives the company runway, however short, to continue its attempt to pivot toward higher-margin private label brands like Yokin and Mokar. If they can ever monetize the Chewy of China narrative, they need time, and these structural maneuvers bought them that time.
I'm sorry, but I just don't buy that the cost justified the means for existing shareholders, or that the operational pivot is realistic given the 34% contraction in sales. The data, it overwhelmingly points to a systematic transfer of capital, engineered by the timing, the splits, and these institutional mechanisms. The combination of structural engineering, the orchestrated pump, and the immediate, steep dilution event confirms BQ is best understood as a sophisticated financial instrument. Retail investors who look at the low price-to-sales ratio of 0.03 see a classic value trap, because they ignore the fact that the share count is expanding exponentially via these toxic financings while the operating business shrinks. The volatility is driven by institutional arbitrage, not by pet economy fundamentals.
So, we agree on the complexity and the severity of the structural issues facing Boki. While I maintain that the actions taken, however aggressive, were necessary survival tactics to secure essential capital and maintain compliance, ensuring the company has a future, however fraught.
I conclude that the evidence clearly shows this was a death spiral financing mechanism, expertly utilizing market microstructure and engineered volatility to facilitate the immediate, profitable extraction of value for structured finance participants at the direct expense of existing shareholders.
The analysis of Boki, I think we can both agree, provides a crucial case study in understanding the extreme risks inherent in distressed microcap Chinese ADRs and the limitations of traditional fundamental analysis when financial engineering really dominates the equity structure. So to summarize our discussion, I argued that Boki's aggressive splits and offerings were necessary structural maneuvers to maintain listing compliance and secure vital operating capital in a deeply distressed environment.
And I maintained that the sequence of events, especially the use of the October surge to execute a deeply discounted offering facilitated by high-speed institutional mechanics like the 9.99% blocker and warrants, defines this as a predictable death spiral designed for capital extraction.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.